let's go across to Seth Freeman. He's Senior Managing Director at Glass Racknner B. Riley. Seth, very good morning to you from where we are. Always great to have you on the show. Let's start about, what are we seeing as far as the U.S. economy and all of these high-frequency indicators are concerned, like the PCE data that came in. Is this a resilient economy, or are we not seeing the storm brewing so far?
Well, I think there's a very nuanced storm going on, and we saw the inflation, the PCE inflation rate go up, and we are seeing just significantly higher consumer prices across the board. At the same time, U.S. consumers are fairly tapped out on their consumer credit, on credit cards and so forth, and we're not getting significant relief in mortgage rates. So all of these things are weighing on our economy. Plus, we still haven't seen the full effect of tariffs.
So therefore, what's the bottom line, Seth? The U.S. equity markets, as Tamanna very rightly pointed out, Teflon coated. It doesn't seem to be impacted at all by any of the data that we've been speaking about. If anything, we're paying more attention than the U.S. market is. That's a joke. But having said that, where does it culminate? Where do you see it heading towards the end of the year? Do you see money eventually moving out? Emerging markets, China is looking reasonably good, continues to do so.
I know I said this before summer or during summer. I said, let's wait and see what happens after Labor Day. It's very confusing to see the markets, the U.S. indices rise with all this turmoil. We had this little mini storm with the confusion over, the $100,000 visa fees, what it applies to. We all saw the tape of flights or, Indians in the United States wanting to get off flights. It seems that we have a lot of volatility that's caused by kind of knee-jerk reactions to bizarre policy pronouncements. So all that said, I think we're going to really have to see if the Fed reduces interest rates one more time this year, and how that impacts sentiment, because I think at this point, it's all about sentiment.
The affordability set, as I saw in various articles over the weekend in the US, is very, very low. I don't know how much of a leeway does the Fed have. But independent of that, I saw a statistic which said that the top 10 stocks account for 78% of the market cap. This is higher than 1930, higher than the bubble, dot-com bubble, etc. What gives here? Does this change at some point of time, and therefore do the Mag 7 come off and the other things rally, or does everything go down?
Well, when it's so heavily weighted like this, it doesn't take much to push the indices down, especially with Nvidia and some of these other huge stocks. So that's where the risk is. You make a really important point that the index performance really does reflect these huge market cap stocks.
Seth, thanks so much for joining us as always this morning. Pleasure having you.
Thank you.